All right, my next guest, he's a retirement guy, right? He looks after your retirement income, maybe savings for your health issues, maybe, and how about education, all the stuff that's pretty important to us, right? Those are the three big things, I would say. And that consumer price index today that came out, it rose 0.3% month over month in June, and in line with the consensus, and it accelerated from the 0.1% that we had in May. But that's according to the data released by the Bureau of Labor Statistics today. On a year-over-year basis, it came in up 2.7%. Which is a rise versus a 2.6% consensus, and we had a 2.4% last month. Now, core CPI, which excludes food and energy, increased 0.2% month over month, which was slightly less than the 0.3% expected and hotter than the 0.1% increase in the prior month. So on a year-over-year basis, the core number rose 2.7% year-over-year versus a 2.9% expectation and a 2.8% prior. So all in all, it means that Inflation Nation will be disappointed that these numbers weren't hotter. I don't think it will disappoint my next guest. Please welcome to the show, Craig Bolanos. Craig, I kicked it off with the fact that you kind of look after people's education, retirement, maybe health, money, and those are the three most important things, I think, as you get older in life. And so you got to make sure that, you've got sound investment ideas. And I wanted to get your take then on what the CPI number came out today looking like, because you talk about maybe a soft landing still in play. It doesn't seem to be that we've got anything too crazy out there. We had bank earnings as well. I don't want to put too much in your mouth there, but I think that all in all, you're probably pretty comfortable.
No, all in all, on a Tuesday, I'm happy. As long as the taco trade, and it is Taco Tuesday, as long as taco continues to exist, this market's going to be just fine. That being said, soft landing is still here. 2 Fed rate cuts by the end of the year, still here and fully baked in, fully priced in, by the way. But Scott, I do push back a little bit. I know the inflation data didn't come in hot. I think some naysayers wanted it to be hot, but I think the inflation data and the stubbornness points to the fact that when we get deeper into the year, it's going to be harder to curb these inflation numbers, because I think consumers are going to be asked, it's just natural, to pick up 1/3 to as much as half of the embedded cost, because these numbers, I mean, we started the year with 0 tariffs. We got all sorts of tariffs now. Someone's got to pay for it.
Yeah, I mean, 3 years ago we had 9.1% CPI too, and today it's 2.7%. So I mean, I get it, and I'll say we probably are discounting something that we don't talk about very much, especially on this show. But I think artificial intelligence and the productivity is a massive deflationary weight, and that starts to slowly but surely. We've seen, and it doesn't get really reported, a lot of layoffs. Microsoft, I mean, you go down the list, 9,000 here, 7,000 there. People are being laid off. A lot of it's got to do with some artificial intelligence and some new technology coming in. And I think that is ultimately going to be a deflationary pressure, and it might balance out any slight inflationary pressures we get from tariffs. Now, you go back over the years, I still think that tariffs could possibly be deflationary in some arguments, but I'm not as worried as the rest of the market is. But if you look at, say, the newsroom of the New York Times this morning, they were very. You can laugh. You're exactly right. You know what they said. Accelerating, exploding, whatever the hyperbole is. But I don't know. I think that there's going to be a lot of disappointed people out there that wanted to see inflationary numbers that could hurt Donald Trump.
Well, Scott, you know what's crazy? I've been through 3 markets in 9 months. I remember Trumponomics, how great it was, November through February. And then we moved straight into recession paranoia. Gosh, that was awful. And now we're living in the third wave, which is we ignore all the macro headwinds and we focus on the intrinsic value creation from AI, which is real. It is absolutely real. I think people are still underestimating the simple fact that only 9% of corporations in the United States of America have adopted some form of generative or agentic AI. And when you move that needle, I think it's not just going to replace some human beings, which, by the way, is going to drive the unemployment numbers up, which is the reason the Fed is going to cut rates, because remember, they have a dual mandate, stable prices, and maximize employment. But it is the earnings earnings per share growth that's going to defy people's logic. And that earnings per share growth is going to be coming from the simple fact that AI is an enhancement to the human capability. It's not a full replacement. Well, at least not yet.
Yeah, right. And so 9%, really, that's an amazing figure.
Yeah, it's an amazingly low figure because that's the best estimation for both public and private corporations. Remember, not everything's a publicly traded security. We don't have the insight that we once did, but that level of weak penetration inside of a business model tells me that this is such a transformative story that I think people need to get more educated, more informed, and more involved in. And that doesn't mean you have to buy the Magnificent Seven companies. It means think about which industries, which sectors are going to best leverage AI for earnings per share growth and operational efficiencies through the elimination of repetitive tasks. That is the real story.
I mean, we've had guys on that talk about AI all the time. And as much as people talk about AI and high tech, you'd think that it was way higher than 9%, right? And so if those folks are telling me that we're the second or third inning of this AI revolution, 9% says we're not in the second or third inning. We're probably still the pitcher's warming up. We haven't started the game yet.
Well, I think we're in the second or third inning of what I call the AI evolution of what it can do. But I think we're in just starting the first inning of adoption, right? I mean, remember, there's the creation thereof, and then there's adoption and utilization. I mean, think of how many great technologies were created, but how slow we were on the uptake of the adoption itself. And that's exactly what's happening here with AI. And that's how you tie it all together. You mentioned the Fed, you mentioned inflation, you mentioned rate cuts, you mentioned soft landing. Again, thank heavens for the internet revolution. Thank heavens for the PC revolution. Thank heavens for the energy renaissance. And just when people thought all hope was lost, here comes AI. And I just hope we continue to do energy and build data centers to keep our lead relative to any other country around the globe.
I mean, I couldn't have said it better. And I think and I know that technology can be a double-edged sword, but for all the bad things that people worry about out there, think about all the things that's going to help you with health and running your businesses. And I mean, I really do think that this is, we're on the cusp of something very exciting, at least. So I appreciate you coming on, Craig. Always really loved what you have to say. Great content. Thank you very, very much. Craig Bolanos, he's a wealth partner and founder of VestGen Wealth Partners up in Chicago. All right.